Hello, dear student. Today we are going to understand Accountancy Chapter 12 Ledger. In this chapter, we are going to discuss meaning of ledger, important points regarding ledger, format of ledger, and the practice question relating to ledger posting. Before started the meaning of ledger, we have to recall the accounting cycle. Accounting cycle is started with transaction is happening in the business. Then we have to record the transaction in the journal. Then we have to post the transaction into the account. This process is known as the classification process. To know the particular account balance, we do posting. Then we have to maintain the balances in a statement that is known as trial balance. Then with the help of trial balance, we have to prepare the final accounts. To know the profit, losses and the financial position of a business, we prepare financial statements. Now we are on the second step, that is posting of transaction from the journal to the ledger. Ledger is a particular account. For example, we have to prepare cash account, sales account, purchased account. Accounts are related with the assets, accounts are related with income and expenses, persons related accounts are prepared. For example, your bank account is open to know the bank account balance. Same as it is, we have to prepare the accounts in our business to know the balances. Now, a ledger account can be defined as a summary statement of all the transactions. All ledger accounts are prepared to know the balance. It is related to a person, as I told you, it is related to a person, assets, expense, or income. Person means RAM account, Sham account. Asset means machinery account. Expense means salary account, wages account. Or income account means commission account, interest received account, etc., which have been taken place during the given period of time and show their net effect. A group of account is known as ledgers. Yes, we have to prepare multiple accounts in our business to know the particular balance. As we discuss the meaning of the ledger, now we have to understand some basic point regarding the ledger. Ledger is a book of final entry. The transactions recorded in the journal are posted into ledger. Yes, general transactions, general recording is posted into ledger. We have to record the transaction firstly in ledger and then we have to post it into particular account. Ledger is divided into two parts, debit and credit, and each part is having columns like date, particular, JF stands for general folio, and the amount. Ledger accounts are totaled and then balanced, because we want to know the particular account balance, like we want to know the sale account balance in the particular financial year. The process of recording is called posting from journal to ledger. This process is known as posting. Trial balance can be prepared on the basis of ledger account as per our accounting cycle. Financial statements can be prepared on the basis of ledger posting also. Ledger posting of recorded transactions in the journal is the second stage. As I told you, it is the second stage according to our accounting cycle. With the help of this example, we have to understand the format of ledger account and the posting of ledger account. Ledger account have two sides, debit side and credit side. Same two sides is equally divided into two parts, debit part and the credit part. Both have same columns like date, particulars, general folio, amount. Date, particular, general folio and amount. This is the format of the ledger. Now we have to understand the transactions meaning and one by one posting. On January 1, transaction is cash balance in hand. That means the opening balance of the cash. And we have to apply real account on cash. That means what comes in debit, what goes out credit. The opening balance of cash is related with asset because cash is an asset. So debit balance will be applied over here to balance BD. If there is a liability, then we know that liability is a credit balance, then we have to record the opening balance on the credit side. If there is a debit balance means asset related balances, and credit balances means liability related balances, as we discussed in previous chapters. January 3 transactions. You have to understand only one concept, that is, if cash is debit, then you have to go with debit side. If cash is credit on a particular transaction, you have to go with credit side. Now, the third January transaction is, for example, bought goods for cash. The transaction is recorded like purchase to cash. In this entry, purchase to cash. That means cash is credited. So we have to go with the credit side with the name of purchases of rupees 2000. In the next transaction, January 5, cash received from Mohan. That means what comes in debit. Cash is received, then cash is debited to Mohan. Then we have to go with debit side to Mohan account. Goods sold for cash. That is cash account debit to sales account. Cash is debited, we have to go with cash debit side. Then we have to use the front name as sales account. The balance is 2200. Paid to Ram. Paid to Ram, the amount is 3000. Ram to cash. That means cash is credited. We have to take the word Ram on the credit side. That is 3000. Paid salary. If expenses is paid, expenses, according to the rule of nominal, it is debited. Then cash, what comes in debit? When cash is come, it will be debit. When cash is go, it will be credited. So in this entry, salary to cash, and cash is on credit side, so we have to go with credit side, and then we have to use the word salary account. Commission received. Again we received cash account debit to commission. Cash is debited, so we have to go with debit side. The word is used commission. Amount is 1000 rupees. Now we have to do the balancing of particular account to know the balance of cash account. Here amounts are given. We have to check the debit total, we have to check the credit total. Debit total is 8700 and the credit total is deficient with 1300 amount. So we have to give the balancing to the credit side to balance the particular account. All these transactions are related with the month of January. So January transactions are over. We have to give that particular balance to the next month, that is February. This is your ledger concept.